Hi, I'm Lilla, your finance translator, and today I'm here to explain where to start when you're starting a business and some of the basic concepts that you need to understand in order to position yourself in the best possible way and set yourself up for success, I suppose. So the first thing we'll talk about is the difference between a business and a startup. A, because people are curious about it, and B, because you need to know that in order to be able to strategize properly. So I think the easiest way to explain that is that a startup is a business designated to grow fast and scale, whereas a business is designed to generate consistent income. So we typically tend to refer to the person starting a startup as a founder and a person who runs a business as a business owner. With a founder, they typically build something to scale, take on more risk, and often plan to sell or exit. Whereas a business owner typically builds something to generate income, focuses on stability and sustainability, and plans to run it long term. So the labels don't really matter too much, but the intent behind what you're building really does, because it will impact kind of what you do with your money. So if we go for an example to just simplify that a little bit, I do love my fighting example, so we'll use a local boxing gym. A local boxing gym is a business. You find the space, you get the equipment, you build the reputation, you attract members locally. It's proven, it's repeatable, it's income driven. Whereas if you want to think of a scale up or a startup example, that could be an app that teaches boxing skills to millions globally. So that would be a startup because you need the tech, you get the scale there, and you need the distribution. Plus, you probably need the external funding to be able to achieve that. So it's the same industry, but completely different game. So why does this matter if you're looking to start a business? Well, the biggest difference shows up in how the money flows. So as a business, you usually start with your personal savings or a bank loan. That's your capital. Your capital is what you use to fund your endeavor, whatever you're starting, your business or your startup. A business will also focus on becoming profitable early because you've got the loan to repay and probably your living costs as well if you've quit your job. And you grow at a steady, controlled pace. Whereas with a startup, you often raise money from investors and there's not as much rush or pressure to make that profit straight away. So you prioritize your growth over the profit. You accept the losses in the short term in order to grow faster later on. In order to simplify this, you can say that a business protects its cash, whereas a startup spends cash to grow. And that's why it's important to understand the distinction. If you don't understand which one you're building, you can make the wrong decisions really early on, and that can lead to severe consequences. Either way, whether you're a startup or a business, you tend to follow the same kind of life cycle. So every business, startup or not, follows a path which can be compared to a tree. So you start with the idea, which is your seed. You launch the idea, which is the same as planting your seed. That grows and shoots up really quickly, but then it reaches this maturity, this growth stage, and that's where the growth kind of stagnates. And that's quite important to understand about your business too, because linking back to the earlier point, once it hits to that maturity, the growth slows down kind of stage, you need to figure out what you're going to do. Are you going to accept the slower growth and potential decline if you don't innovate and stay competitive? Or are you going to exit at that point and let someone else take over and scale up the company with increased resources, maybe higher resources than what you had? So that's why it's important to understand that business life cycle so that you know what your end game is and you know when you've hit every stage. Because once you hit maturity, you can potentially go into that decline, so you have to be ready for it. But here is where it gets interesting, because just because you're running a business doesn't mean you can't sell at a certain stage. So most business owners think, this is my income, I'll run it long term. However, a lot of business owners could still sell if they built with that in mind. There are plenty of larger companies and investors actively looking to buy smaller businesses, which we'll talk about in future videos a little bit more. And this is a sector I'm very familiar with because I work for private equity backed companies, which means they buy up loads of little companies, combine them into a bigger company, and then sell them on. So now that you know your end game and know what your plan is at a certain point, once your business succeeds and reaches a certain level, where do you actually start? Well, this is where most people overcomplicate things, because they try to strive for perfection, but actually in your first week, that's not the key. The key is to have clarity. So here are some steps that we'll go through now of, I would say, in the level of importance, and some useful tips for someone who's starting a business. So number one, I would say you need to validate your idea. This doesn't mean checking whether it's a good idea or whether people like it or not. I mean, that could be the case and hopefully will be the case. But the key thing to note is, will someone actually pay for this? And that is your basis for success. That's the only validation that matters. Number two, the second most important point, is to keep your setup simple. You don't need a 50-page business plan. You need a clear offer, a rough idea of pricing, and a basic plan of how you'll get to customers. That's enough to start. The third tip, which is more of a practical point, but it will save you a lot of headaches later, is immediately set up a separate bank account and a separate email address for your business. That will help you keep track of all the expenses that are relevant to the business, and then hopefully mean that you're not overpaying tax later on. It will also help you keep more organized with everything as the business grows. That's something we'll cover heavily over the next couple of weeks. These are not most exciting, but they're very important points. The next thing you'll need to do as a business, and this is the whole reason why I kind of started this account, is set up basic tracking. So knowing your numbers and your finance inside and out can be the difference between you succeeding or failing. A lot of the time, finance professionals overcomplicate these things by using jargon and kind of put people off. You might not like maths, but there are certain numbers you have to know in your business in order to understand whether you're going in the right direction or not. To start with, I would just keep track of the money coming in and coming out. However, over the next couple of weeks, we'll be covering some of the key numbers that you should also be keeping track of. Another point to note is understanding your pre-revenue. So what is pre-revenue? Pre-revenue is that awkward stage of the business where you haven't actually sold anything yet. So you don't feel like you're a business, but you really are, because you're testing the idea, you're building something, and you're speaking to potential customers. That means you're already in the game, but you just don't want to stay there for too long, of course. You want to start selling as soon as you can. And of course, the most important thing when you're starting a business is the money to be able to initially invest into it. So that is referred to as your capital. There are 3 different ways in which you can get hold of capital, I suppose. One of the ways is through your personal savings. So that's, you're taking all the risk, but you get to keep all the control. Like, the business is yours, but you've invested your savings, so you could potentially lose them if it doesn't work out. The next way of securing some funds is through loans. So the good thing about loans is you get to keep the ownership, but you have to repay the loan, obviously, whether you're successful or not. So it's still a big risk on you. And finally, the third way of getting funding is through investors. So that means giving up a part of your business, which we refer to as equity, and in return you get the money. However, you've just given away someone a little piece of your company. So which one is better, equity or loans? So equity, again, as a reminder, that's where you give away the ownership of your business. And loans is when you take on the financial obligation to pay something back. There is no right answer. It depends on your risk tolerance, your goals, and whether you're building for income or scale. A lot of people like to have a mix of both here. And that's it, really. These are some of the key points that I think are important to note before you go ahead and start a business, and some practical, I guess, a little bit of practical advice on the best way to start. Some final thoughts on kind of all that we've discussed today is that you don't need to be a founder in order to be able to sell your business, but You need to know from the get-go what your strategy will be long term. You don't need to follow the startup culture that you hear a lot about on TikTok and Instagram and other social medias. You just need to decide, am I building something to run or something to grow and sell? Once you're clear on that, everything else becomes easier. Your financial decisions, your hiring decisions, your growth strategy, and most importantly, your expectations.